And we get to that E, which is the last part, which is this feeling of empowerment, being empowered. And the concepts here should allow you to actually move forward and towards your full objective and your happiness and create sustainability. So now that we have some base concepts, now that we have an understanding of the ways in which we can create cash for ourselves, and we have a way of moving ourselves forward in terms of understanding the vehicles that are there to help us grow our wealth. How do we actually start to do? How do we make these things a reality so that way our decisions and actions are moving forward? Well, these concepts should help. They are there to allow you to understand what's in front of you and not feel fearful of it, but just look at it with a degree of certainty so that way you can move forward. You know, compound interest is important because it allows us to understand two things very easily. And I'll speak first about expense side. If we don't pay our credit card bills and we just allow this interest to accumulate, at some point we're paying more for the same goods and services that we pay more for goods and services than we should, basically. Because we're delaying the repayment and interest is being added on, something that costs $10 is now $11, and in a month it's going to be worth $12. And so now we have $2 of interest that we shouldn't be paying because we needed to pay $10. So now we have to pay 12. And so simply understanding what compound interest is and how it takes more of your own capital and your income away allows you to do things to prevent that from happening. One of the things that we can do to prevent that from happening is understand the concept of the time value of money. Meaning, if I put my money away and I invest it into something that I want to grow it to, then instead of me paying interest rates to other people, what I'm doing is I'm actually paying myself more money in the form of additional money over time. And so that's what time value of money actually means. If I put money away for some specific rate of return, in the future, I'm going to have more money, right? A dollar invested on January 1st is going to be worth more on December 31st, just because of time, right? Just because of time and a rate of return. And so if we keep those two things in mind, we can always find a process to make money. And that's what leads to net worth. Net worth is an equation. It's when we look at our assets minus our liabilities, and it's really how we look at our financial health overall. It's important to realize that a lot of people don't have net worth because we don't have assets. We have more liabilities, we have more bills, but a lot of people don't have assets like a home or a car or retirement accounts that allow them to actually have net worth. So a lot of people actually have a negative net worth. More than half of Americans have a negative net worth simply as a result of doing that. And when it comes to the way our interest rates or the way inflation or the way compound interest or the way that we are looking at time value of money, there is either going to be a fixed way, a very static way where it doesn't change, or it's going to fluctuate a lot. And if it's static, we're going to call those fixed rates. And if it changes a lot or fluctuates a lot over time, we're going to call those variable rates. And so when we look at interest rates or the compounding interest or time value of money, all of those are going to be determined based on whether you are experiencing a fixed rate, something that doesn't change, or a variable rate, something that changes over time. One of the things to keep in mind is that we are often quoted rates based on what happens in a year. However, oftentimes they may be what's called accrued or paid to that individual or that entity on a monthly basis, on a quarterly basis, or whatever the case may be. So you may receive like a monthly payment for 12 months, and then they sum that up to say this is the annual percentage rate. So be aware of how your rate is actually being calculated. Sometimes it could be fixed or variable, but be aware of whether it's actually being accrued and actually paid or calculated on an annual basis, or if it's just accumulating monthly rates or quarterly rates and then calling that its annual percentage rate. That's how you compare and contrast what is good for you and what may not be good for you. We didn't have tax advantage accounts. Like the IRA is the most common one. And what's beneficial is that it allows you to grow your assets, achieve capital gains without having to deal with that tax at first. And basically, what will happen is that your money is able to grow without those taxes. And then as you get older or as you move into a lower tax bracket, that's when you spend the money and therefore you're going to pay tax then. And so that's the advantage with the tax is that we get to defer that tax on our growth. And then when we actually spend the money later on, we're paying a much lower tax rate. And most of the ways that you can find these tax advantage accounts are going to come from your employer sponsored retirement programs. And they all are going to have different names. They can be called a 401k, a 403b, a 457 plan. They're all the same. It's an employee-sponsored retirement program. They just have different tax ramifications, and so they are just named after different tax codes, the 401k, 403b, and 457. The 401k is for uh, organizations, private and public organizations, for-profit organizations. 403Bs are for nonprofits. 501Cs are for nonprofits or churches or stuff like that. 457s are primarily governments, municipalities, local state government retirement plans. We all have a basic retirement plan and it's called Social Security. We start paying into it the second we work, and then we become vested in that after 10 years, and our money just grows for us. And Social Security is one of the best insurance products ever created. It uses your own money, it stores it away, it grows it for you, and uses time value of money, and then it automatically converts it into some stream of income. And there's not another product that's able to do that. And so Social Security is very unique in the way it's able to do something like that. A lot of us used to have pensions. So the baby boomer generation used to work for a company for a very long period of time, and they would have what's called a pension, which was a defined benefit plan. And they don't really exist. They're 100. They don't really exist as or as prevalent as they were before. They do exist in certain industries. Or if you have unions, for example, teachers still may have pensions. But one of the things to keep in mind is that this is done by the employer, right? So it's employer funded, completely employer funded, and it gives that employee some portion of their salary, right? 2/3 of their salary once they get into retirement. Annuities are important in terms of a concept to understand because that's where you create periodic income. So regardless of how much wealth you have, if you want to have a stream of income, there's only a few ways to do so, and annuities are one of those ways. Bonds are the others, where you take this bigger amount of money and you turn it into a stream of income. And so when we talk about annuities, we're talking about creating a stream of income from some bigger pool of money. And one of the best ways to do that is through insurance. You have to protect yourself against financial loss. There's no reason to go on this wealth journey, save for yourself, do everything that you possibly can, and then have something happen that puts it all at risk. And so insurance protects you. It also indemnifies you, what's called brings you back to the place where you were, right? It makes you whole again, is what's the purpose of insurance. Estate planning is just a preparing your wealth portfolio or your assets for wealth transfer when you die. So upon death, how do we actually take all of the assets in the portfolios that you have and just move it over to somebody else that you designated? That process is called estate planning. This process of taking your wealth and upon death moving it to another generation or another part of your family. And then sometimes we have to think about how much, once we accumulate, how much are we trying to withdraw? And so for a long time, there's been this concept of if you can withdraw 4% of your actual income or 4% of your accumulated wealth for your income, that should help you survive. And so what we try to think about is how much money is it going to take for you to live comfortably for a year? And then we're trying to look at 4% of that and 4% is going to be that annual salary, and then we're going to look at a bigger total to come from there. Okay. So for example, if we wanted to pay you like, I don't know, $40,000 a year, we'd have $1 million paying you 4%. And then it just allows you to get that amount of money that helps you out. Okay. And so those concepts, that's going to finish up for the E. And so at the end of this, empowerment is what you should experience. I hope it's been helpful, and I hope that it provides at least the right degree of oversight and understanding in what it takes to essentially be fine. And if you have any questions, always here to help.